Hey Harvesters, and welcome to the channel. My name is Matt. In today's video, we're going to be going over the options trades that I have executed for May 15th. That's my covered calls, cash secured puts, how I chose specific strike prices, and everything in between when it comes to options trading. If what I just said is a foreign language to you guys, be not dismayed, for I'm with you. I will explain it, break it down to as simplest format as I can so that you guys can digest it. And let's get started. The whole point of my channel is to create a income stream from this Robinhood account as much as possible. I have other investing accounts that are for long-term wealth generation, like all the tax advantage accounts, but this Robinhood is strictly for premium generation. And then as a secondary effect, capture some of the upside. And if you guys are interested in this type of content, don't hesitate to subscribe, like the video, and follow me on my journey. I like to track everything in a nice, neat format in a spreadsheet. So let's take a look. First thing I like to talk about on my channel is my Robinhood account value. I do this for a couple of reasons. One, first and most, is transparency. I am in the trenches with you guys. I am trading, and I am actually living the philosophy I am speaking about from my mouth to the channel to you guys. One of the things I promised myself when I was doing this YouTube is I'm going to annotate all of my wins, but also all of my losses. And you'll see one of my losses once I go over to the spreadsheet. But without further ado, the Robinhood account is at $96,435. and 43 cents. And over the last month period, it has significantly grown, about 12%. But I track it in a different way in the spreadsheet. So let's actually head over to the spreadsheet and talk about the individual tactical movements I made for these options trades. All right, guys, let's talk about May 15th and let's rip the Band-Aid off. The amount of premium and appreciation that I realized today for May 15th is about $3,191, which is a massive day. It's almost 10 times what I made in the previous day at May 14th. Let's talk about what actually happened and at an individual level. So the first thing that happened is I had about 200 shares of SPY going into May 15th. And then at the end of May 15th, both sets of 100 shares of SPY were assigned. So let me explain what happened. So the first set of 100 shares of SPY, I actually bought a few days ago from a cash secured put. Cash secured put was assigned. So I bought it at the 587 and I chose a strike price at the 587 because my intent for this 100 shares of SPY we're talking about now is I wanted to sell at the money and get rid of it because technically I had a little bit of them on margin. So I loaded up on the premium and I made about $102 of premium today from that trade. And then I made no appreciation because I pretty much sold at the money. I bought at 587 and I sold a strike price at 587. With that covered call, I made $102. For my second 100 shares of SPY that was assigned, I bought these at the 559.63 and then I chose a strike price of the 589. And then they were at the end of the trading day today, it was the SPY closed at the 590.46. So then therefore the covered call was assigned because 590 is greater than 589. And I basically sold my 100 shares of SPY at this 589 price for a $2,937 profit. The next thing I did here is for this 100 shares of SPY, I actually only made a premium of $43 when I chose that 589 strike price. The day before I chose a 591, and then today I wanted to be a little bit more greedy because it yesterday didn't close close to 590. So I'm like, let me be more aggressive. And by being more aggressive, I had my shares assigned, but it is what it is. For QQQ, I did a cash secured put and I chose a 514 strike price when the QQQ opened at the 516.53. I made about $100 and locked that in. And then for IWM, I also owned 100 shares of IWM that I ran a covered call on. I only made like a dismal $10 from it. Because the strike price was 209, it opened at 206.48. But because I bought these shares at 208.51, I wanted to make sure I choose a strike price where I wouldn't lose money. So the only strike price at the money that I can choose without losing money is the 209 strike price. So I made $10. Shares were not assigned. Cash secured put for QQQ was not assigned. So from the premium, I made $253. From the actual trade of selling 100 shares of SPY at the 589, I made another $2,937 and for a total summary of $3,191. So super massive day. I'm not going to explain the nitty details of why I chose specific strike prices here, but once we go over to the Robinhood, when I'm going to explain what I do for tomorrow, I'll explain how covered calls work, how cash secured puts work, and then considerations for both, like winning and losing. Let's head over to the holistic view of how I've been trading these options these last 24 trading days. Hey guys, let's kick this off. For the daily tracker, I track every single trading day and then make a nice holistic percentage here and total value at the bottom. But for May 15th, we made $3,191. We realized that gain, and my account has been trending in the upward direction. From when I started April 11th, my account was about $86,312, and currently my account's at $96,435.35. If we look at the percent gain from this 86,000 to this 96,000, it's about 11.73%. And the amount of premium and appreciation I realized over this last 24 trading days is about $7,669.53. Now let's scroll over to the trade win percentage. I'm winning 95.83% of my trades. I've had 23 winning days, 1 losing day, which then totals 24. If you look at the average premium per day, I'm making about $319.56. If we look at that at a weekly rate, that's about $1,533.91. For the average monthly, we haven't really had good data for monthly, but for the yearly estimate, right now, if you watched my video yesterday, I think it was only like 44,000, but then after this massive upside win, the average yearly premium is looking closer to about $79,763.11 and a 92% yearly gain. I think that's very optimistic, and I don't necessarily think these market conditions are going to continue heading in this upward trajectory. I don't know if I'll be able to capture the upside as much as I did with my 100 shares of SPY. So yes, this might be very optimistic, but from the previous video, I think a good realistic view of how much premium I can make over the next 7 to 8 months in a safe manner is about $29,740.24. So we will see if I can hit that number. I would love to hit the $79,000 number, but that is being very optimistic, and we will see what happens. I've only been doing this for about 24 trading days, and I've only been doing this for 24 trading days consistently. So we'll see. Well, let's head over to the weekly tracker. Over the last 5-week periods, we've had fluctuations in how much I've been making per week. We had one losing week, and then the rest were positive. And the one losing week was mostly from one losing trade on April 22nd. I butchered rolling my options that were below my cost basis, and I was being greedy. I wanted to choose some strike price that was below my cost basis, and then the market blew past it on some positive news. And once I rolled my options, I didn't roll them high enough. And therefore the market continued going higher and then blew past it even more. And that was just a learning point for me. Don't do it again. Even though I had one really bad day, it didn't discourage me from continuing this specific strategy. If you look at that, I think I've won about 19 times in a row after that. Don't let one trading day dictate your trading philosophy. I'm winning 95.83%, and I'm up $7,600 over this last 24 trading days. That's quite impressive. For this current week, we still have one more trading day, and we're already at $4,052, which is a monster week, which I didn't think I was going to get, but here we are, and I'm very excited about that. For the monthly tracker, in April, we were at $2,289.53 of just trading from April 11th until April 30th. But for May, we're at roughly the halfway point of May, and we're already at $5,380. Could we make it a $10,000 a month? Who knows? I think more realistically will probably be, we might add in maybe another $2,000, maybe $3,000 to it. So we'll see. Would I love to see my monthly tracker for May be at 10,000? Yes, but I also don't want to get too riled and start using margin and getting out of hand here. Still want to be safe. And for the yearly, we already talked about the yearly tracker. We're at $7,669.53. So guys, that is the overview. I think this is going relatively on track. Some people have been saying that I timed the market perfectly, but I also realized a lot of losses from investing into high income ETFs, selling out, and then buying into this. So nothing really looks perfect on paper. And I'm pretty sure all of my gains this year are going to be recovering the losses from those high income ETFs. So here we are. But either way, I still think this options trading with cash secured puts and covered calls is by far way better than investing into high income ETFs. Plus, it gives you something to do every day. And for me, I think if you look at the risk to reward, is a lot safer than doing a lot of other things in the market. All right. With that being said, guys, let's head over to Robinhood and start talking about what are we going to do for tomorrow and explaining these covered calls and cash secured puts. Now that we are back at Robinhood, I'm going to describe what I plan on doing for tomorrow at a holistic level, and then we'll go into the nitty gritty. First thing I want to do is I want to straight off the bat buy 100 shares of SPY and then start writing covered calls against them. We'll make a determination if we want to do it at the money. But step number 2, I'm probably going to do a cash secured put on the SPY now that I have a lot of my collateral and cash freed up. And then depending on what's left over, we'll see where we're at. But then also the third leg is for my 100 shares of IWM. I'm also probably going to do a 209 strike price covered call. So let's now go into the details of what that might look like. So let's go over to SPY first and press on the best button of all time, the money printer button, trade SPY options. And let's look at the top here. See this buy call. Don't ever do buy call. 90 to 95% of options traders that do buy call are probably going to lose money. So I just highly recommend doing the safer bet, which is sell call. Sell call is a covered call, and then sell put is a cash secured put. And so what I usually like to do is I like to trade dailies. And so for tomorrow, May 16th, we're making sure we choose the right day. I start looking. So I'm going to buy the 100 shares straight off the bat. And then we're going to take a gander from at this strike price of the 5.9 or at the money of 590.09. I usually like to look about $5 away from that strike price to see what the premiums might look like. So if I were to buy the 100 shares of SPY and then I can get this $49 premium at this 595, I'm probably going to go ahead and select that because that's a, $5 away from the at the money. That's going to be about $500 appreciation plus locking in $49 of premium. That's great. So let me explain what a covered call is first. So to run a covered call, you need to own 100 shares of the underlying. Hence, that's why I was talking about buying 100 shares of SPY right off the bat when the market opens. So you need 100 shares equals one options contract. And for every options contract, you're going to get paid a specific number depending on the strike price. So for this 595 strike price, which is about $5 away from at the money at the 590, you're going to make about $49 of premium. And there's two ways it works. So the first way that this strategy works is investors are going to pay you the upfront premium of $49 to lock in selling your shares that you own to that investor that paid you that premium at this 595. If for whatever reason the stock market and SPY at the 590 does not appreciate to this 595 or higher, you basically keep that upfront premium and then you get to keep your shares and you get to rinse and repeat this strategy over and over again until your heart is content with money. But then the second thing that could potentially happen from the strategy is that investor pays you that upfront premium. We choose that 595 strike price, but then the market is super hot and then it blows way past it, say blows all the way up to this 605 number, right? So the investor, they paid you that upfront premium at that $49, but even though the market shot up to 605, you're locking in your gain only at 595. So you basically missed out on a potential $1,000 of appreciation, but from this 589 or this 590 to that 595, you got that $500 of appreciation, but then you missed out on 595 to 605. So that's the one negative side of running options. You basically, or covered calls, is you limit your gain depending on the strike price you choose. So that's kind of the two different scenarios that could potentially happen. So for tomorrow, we'll see. Maybe I'll be a little bit more aggressive. I might choose this 593, maybe make this $100 of premium. Yeah, let's do maybe this $100 of premium. Now let's look at the cash secured put. So the SPY is trading at this 590. So let's look about $5 away to get a gauge. Yeah, maybe this, I would run a cash secured put at this 585. Maybe let's do this 586. So let's talk about what's going to happen. The at the money for SPY for a cash secured put is trading at this 589.99. We'll just say 590 to make it nice and even. So how a cash secured put works is an investor is going to pay you an upfront premium to offload their shares they own to you at a specific strike price. So say we choose this 586. Basically, that investor is paying you $76 a premium for you to set aside $58,600 of collateral, because 100 times 586 is $58,600. Because if the market goes down and gets below this 586 point, you're going to have to get assigned these shares at 586. So that collateral is now going to be used to buy those shares, and you own 100 shares of SPY at the end of the assignment. but that's not necessarily going to happen at every single time. So let's talk about the scenario. First scenario, let's say your shares, you don't get assigned those shares. So the investor pays you that upfront premium of $76. The market gets nowhere near this 586 strike price. So the way cash secured put works is at this 586, it has to be at or below for you to get assigned those 100 shares versus the call. It's different. For you to get assigned on your shares for SPY, you have to be at 593 or above. So there's just a difference. Covered calls and calls, you have to be above to get assigned, and then puts, you have to be below the strike price to get assigned, at or below. But going back there, let's go back to our 586. So investor pays you the upfront premium. SPY does not go anywhere near 586. You keep that premium, then your collateral gets voided. So basically it frees it up so that you can use that collateral for another trade. The second scenario that could potentially happen, and we'll talk about the negative side effect of this, is so investor pays you the upfront premium, and then the market blows way past this 586 and it goes down to, like, we'll say 576. So basically you locked in buying that investor shares that paid you that premium at the 586, but the fact that it went down another $10 of shares, you basically lost $1,000 of appreciation. And the bad thing that can happen here is if you're trying to sell covered calls with these newly acquired shares, the premiums are going to be a lot lower because you're going to be choosing premiums that are further away from the dollar cost average and what the market is trading at the money. So then there's a couple of scenarios here. You can either settle a loss, which I highly recommend don't doing, or number two, you just wait it out for the market to recover back to that trading point at the 586. And then once it gets closer to this 586 number, then you could choose strike prices that are going to start making you more premium. So there's a couple of different scenarios that could potentially happen. So that's what I plan on doing for SPY. Let's go over to IWM, see what it looks like. Okay, don't forget sell call. I have 100 shares. SPY is the IWM is trading at this 208.23. I'm going to choose this 209. It's funny because yesterday this 209 netted me about $10, and then tomorrow is going to net me about 69 if the market stays exactly the same. Quite interesting. But I do want to offload these IWM shares, so I'll probably choose this 69. Maybe choose this 210, but I kind of want to offload these IWM shares. I'd rather have that cash or collateral used for a bigger chunks of money like QQQ or SPY because just the premium is going to be a lot higher. So yeah, so for IWM, just going to do a covered call pretty much at the money. It's trading at this 208.23. I bought the 100 shares at 208.51. So I pretty much have to choose this 209 at a minimum so I don't take a loss in the appreciation of running this option. And then let's go over to QQQ, and I plan on doing maybe a cash secured put on QQQ depending on if I have money left over. So let's go to trade QQQ options, sell put. We're making sure we're doing a daily for May 16th. Currently trading at this 518.80. So let's see what kind of numbers we're dealing with. 188, 154, 126. I might maybe lock in this cash secured put at this 515 for QQQ. For this cash secured put, I'm not necessarily worried about my $5 away strategy because I'm not trying to capture some of the upside. I'm just trying to make this premium for this QQQ. So yeah, guys, that wraps up the video. Hopefully you learned something new. Hopefully this gives you confidence in running your own covered calls and cash secured puts. Let me know what you guys think in the comment sections, what I can improve, what I can do better. What are you still kind of curious on? Matt out, and I will see you in the next video. Peace out, guys.